In the intricate machinery of the global economy, where the flow of oil intertwines with the stability of currencies and the projection of national power, a long-standing pillar of American financial dominance has faced persistent scrutiny and challenge. The petrodollar system, the arrangement whereby much of the world's oil trade is conducted and settled in United States dollars, has underpinned the dollar's status as the premier reserve currency for over 5 decades. In recent years, however, rumors of its impending collapse have circulated widely, fueled by shifts in trade patterns, geopolitical realignments, and the rise of alternative settlement mechanisms. The title "U.S. does the unthinkable to reverse petrodollar collapse and control global oil supply" evokes a narrative of dramatic American countermeasures amid perceived existential threats to this system. Yet, a careful examination reveals a more measured reality. The petrodollar arrangement endures in practice, with oil overwhelmingly priced in dollars, even as diversification efforts by major producers and consumers introduce gradual changes. No single unthinkable action has reversed a collapse, for the system has not collapsed. Instead, the United States has pursued multifaceted strategy, diplomatic engagements, sanctions enforcement, domestic production boost, and alliance building to maintain influence over global energy flows. As we explore this topic, we trace the origins of the petrodollar, analyze recent developments, uncover underlying dynamics, and assess the broader implications for the international order. To grasp the current discourse surrounding the petrodollar, we must first understand its historical foundations and mechanics. The term petrodollar refers to the revenues oil-exporting countries earn from selling crude oil, which, since the 1970s, have predominantly been denominated in U.S. dollars. This system emerged in the aftermath of the 1973 oil crisis, when OPEC nations embargoed supplies to supporters of Israel during the Yom Kippur War, quadrupling prices and exposing Western vulnerabilities. The United States, facing domestic inflation and a weakening dollar after abandoning the gold standard in 1971, sought to secure stable oil supplies and recycle export revenues back into its economy. In 1974, U.S. officials, including Treasury Secretary William Simon and Secretary of State Henry Kissinger, negotiated understandings with Saudi Arabia, the world's largest oil exporter. In exchange for American military protection, arms sales, and economic aid, Saudi Arabia agreed to price its oil in dollars and invest surplus revenues, known as petrodollars, in U.S. Treasury securities. This arrangement was extended to other OPEC members by 1975. Financially, it created sustained demand for dollars. Importers needed them to buy oil while exporters held and reinvested them, financing U.S. deficits at low interest rates. Politically, it aligned key producers with American interests, granting Washington leverage through potential sanctions or diplomatic pressure. In simple terms, the petrodollar recycled oil wealth into the U.S. financial system, allowing the government to borrow extensively while maintaining the dollar's global primacy. Central banks hold dollars as reserves because they are liquid, stable, and required for trade. This framework proved remarkably resilient. By the 1980s, over 80% of oil transactions were in dollars, a figure that remained high through the 2000s despite challenges like Iraq's brief Europe price sales in 2000 or Iran's non-dollar experiments. The dollar's share of global reserves peaked at around 70% in 2000, providing the U.S. with exorbitant privilege, the ability to run deficits without immediate crises, as foreigners absorbed the currency. Step by step, the narrative of potential collapse gained traction in the 2010s and accelerated in the 2020s. The first major stir came from Russia's invasion of Ukraine in 2022, prompting Western sanctions that restricted Moscow's dollar access. Russia responded by demanding rubles or alternative currencies for energy exports to unfriendly nations and settling much of its oil trade with India and China in rupees, yuan, or barter arrangements. By 2023, non-dollar settlements accounted for a significant portion of Russian exports, though volumes were discounted to attract buyers. China, the world's largest oil importer, pursued parallel diversification. Through its Belt and Road Initiative and digital yuan trials, Beijing encouraged yuan-denominated contracts. In 2023, Saudi Arabia conducted its first yuan oil sale to China, a symbolic move amid warming Riyadh-Beijing ties. BRICS nations, Brazil, Russia, India, China, South Africa, expanded in 2024 to include Egypt, Ethiopia, Iran, Saudi Arabia, and the UAE, discussed local currency trade and a potential common payment system at summits in 2023-2025. Reports of mBridge, a multi-central bank digital currency platform involving China, the UAE, and others, demonstrated cross-border settlements bypassing dollar networks. Rumors intensified in mid-2024 when a purported 50-year U.S.-Saudi petrodollar agreement allegedly expired without renewal. Social media and some outlets claimed this marked the system's end, spiking searches and speculation. However, no formal exclusive agreement existed. The 1974 understandings were informal, and Saudi oil continued pricing in dollars. Fact checks confirmed ongoing dollar dominance, with over 80% of global oil trade still in USD by late 2025. By 2025, dollar reserve share dipped to around 57–58%, down from higher levels, reflecting gradual de-dollarization in trade invoices. BRICS intra-trade in local currencies rose, but not a collapse. Oil benchmarks like Brent and WTI remained dollar-priced, and major exchanges operated in USD. The U.S. response has been multifaceted rather than a single unthinkable act. Diplomatically, Washington deepened energy ties with allies, increasing LNG exports to Europe post-Ukraine, signing deals with Japan and South Korea for supply security. Sanctions enforcement targeted shadow fleets evading Russian price caps, with 2025 actions against tankers and insurers reducing discounted flows. Domestically, the U.S. leveraged its status as the world's top oil producer, output averaging 13.5 million barrels per day in 2025, to influence markets. Policies under both administrations encouraged shale expansion, maintaining exports that compete with OPEC+. The Strategic Petroleum Reserve was managed to stabilize prices with releases during spikes. Alliance building included the ITU-2 group, India, Israel, UAE, US, and AUKUS, indirectly securing supply chains. No overt military action to control supply occurred. Instead, naval presence in chokepoints like the Strait of Hormuz deterred disruptions. Hidden factors explain persistence and rumors. The dollar's network effects, deep liquidity, legal predictability make alternatives costly. Switching requires infrastructure for hedging, invoicing, and reserves. Saudi Arabia, despite diversification, pegs its rial to the dollar and holds vast treasury assets. Rumors often stem from misinformation or exaggeration for clicks, amplified by crypto advocates or anti-Western narratives. China's yuan internationalization advances slowly, it lacks full convertibility and faces capital controls. BRICS discussions on a common currency remain conceptual with no 2025 launch. Global implications are evolutionary. Gradual de-dollarization raises U.S. borrowing costs marginally but enhances multipolarity. BRICS trade in local currencies reduces sanction vulnerability. Oil markets remain dollar-centric, stabilizing prices but exposing producers to USD fluctuations. Environmentally, focus on supply security delays transitions to renewables. U.S. influence persists through production leadership and alliances, not monopoly. In thoughtful conclusion, the petrodollar narrative in 2025 reflects anxieties over shifting power more than imminent collapse. No unthinkable reversal occurred because no acute collapse materialized. The system adapted amid diversification. The U.S. maintains substantial control through production, diplomacy, and the dollar's entrenched advantages. Rumors serve various agendas but obscure resilience. Future stability hinges on managing transitions, energy security, climate goals, fair trade through cooperation, not confrontation. As oil remains vital yet finite, the true challenge is balancing legacy systems with emerging realities, ensuring economic tools foster prosperity rather than division in an interdependent world. In the vast and interconnected web of global finance, where the price of a barrel of oil can influence the strength of a currency and the borrowing power of nations, the concept of the petrodollar has long served as a cornerstone of American economic influence. This system, in which the majority of international oil transactions are priced and settled in United States dollars, has ensured consistent demand for the dollar, allowing the U.S. to finance substantial deficits while maintaining its currency's preeminent status. Recent years have seen persistent speculation about the erosion or even collapse of this arrangement, driven by geopolitical shifts, alternative trade settlements, and efforts by major powers to diversify away from dollar dependence. The provocative assertion that the U.S. has undertaken unthinkable measures to reverse a petrodollar collapse and regain control over global oil supply captures the intensity of this discourse. Yet upon close examination, the reality is one of continuity amid gradual evolution. The petrodollar framework remains robust, with oil overwhelmingly traded in dollars, and no dramatic collapse has materialized. American responses have been strategic and multifaceted, encompassing energy production leadership, diplomatic engagements, sanctions, Alliance calibration and alliance reinforcement rather than a singular radical action. As we continue our exploration, we examine the enduring mechanics of the system, the incremental challenges it faces, the measured U.S. adaptations, and the broader ramifications for the international economic order. The petrodollar's resilience stems from its embedded advantages in the global financial architecture. At its core, the system creates structural demand for dollars. Oil importers must acquire them to purchase crude, while exporters accumulate them as revenues, often reinvesting in dollar-denominated assets like U.S. Treasury bonds. This recycling mechanism finances American fiscal needs at favorable rates, contributing to the dollar's role as the primary reserve currency held by central banks worldwide. Reserve status confers benefits: lower borrowing costs, reduced exchange rate risk for trade, and the ability to impose financial sanctions effectively, as access to dollar clearing systems can be restricted. Historically, the arrangement's informal nature has been its strength. The 1970s understandings with Saudi Arabia and OPEC were not binding treaties but mutual alignments of interest, security guarantees and arms provisions in exchange for dollar pricing and investment preferences. Over time, this became the market norm. Benchmarks like West Texas Intermediate and Brent crude are quoted in dollars on exchanges in New York and London, and contracts reference these prices. Even when alternative settlements occur, the underlying pricing remains dollar-based, limiting de-dollarization's impact. Challenges to this dominance have emerged incrementally rather than catastrophically. Russia's pivot post-2022 sanctions involved settling energy sales to India in rupees and to China in yuan or rubles, often at discounts to attract buyers. These bilateral arrangements reduced dollar usage in specific flows but did not alter global benchmarks. India's rupee trade with Russia grew, yet refiners converted proceeds back to dollars for international purchases. China's yuan oil contracts with Saudi Arabia and Brazil in 2023-2025 were notable symbolically but represented a small fraction of total volumes, less than 10% by late 2025. BRICS expansion and discussions on local currency trade or a common payment mechanism fueled speculation. Summits in 2023-2025 explored mBridge and other platforms for cross-border settlements, demonstrating technical feasibility. However, implementation remained limited. Differing economic structures, inflation rates, and capital controls hindered a unified alternative. The yuan's share in global payments rose to around 3–4% in 2025, far below the dollar's 40–50% for trade invoicing. The often cited expiration of a U.S.-Saudi petrodollar pact in 2024 proved unfounded. No formal 50-year agreement existed, and Saudi oil continued dollar pricing. Riyadh's diversification joining BRICS yuan sales reflected hedging amid U.S. domestic debates on security commitments, but the rial pegged to the dollar and vast treasury holdings anchored alignment. U.S. strategies to sustain influence have been pragmatic and layered. Energy independence achieved through shale revolution positioned America as a net exporter, with crude and LNG shipments competing globally. In 2025, U.S. production stabilized high levels, exporting to Europe and Asia, reducing OPEC leverage. Diplomatic efforts reinforced ties. Agreements with Japan for LNG supply security, expanded cooperation with India on refining, and quiet reassurances to Gulf producers on defense commitments. Sanctions remained a tool, calibrated to disrupt evaders without alienating allies. Actions against shadow fleets transporting Russian oil above price caps limited discounted supplies, indirectly supporting dollar-compliant markets. No military interventions or unthinkable seizures occurred. Influence flowed through market presence and regulatory reach. Hidden factors explain both persistence and alarmism. Network effects favor incumbency. Dollar liquidity in forex markets dwarfs alternatives, making hedging cheaper and more efficient. Legal systems in New York and London govern most contracts, favoring dollar disputes. Rumors often originate from vested interests, cryptocurrency proponents seeking dollar disruption, or geopolitical commentators amplifying shifts for narrative impact. China's internationalization efforts face structural hurdles. Limited convertibility and geopolitical mistrust slow yuan adoption as a reserve. Saudi and UAE moves toward non-dollar trade are pragmatic diversification, not abandonment. Dollar pegs and investments endure. Global implications are transitional. Gradual multipolarity in settlements enhances resilience against unilateral sanctions but fragments liquidity, potentially raising transaction costs. Oil markets' dollar anchoring stabilizes pricing but exposes non-US actors to currency swings. Environmentally, focus on supply security delays renewable transitions, prolonging fossil dependence. U.S. control evolves from monopoly to primacy through production and alliances, not coercion. In extended reflection, the petrodollar discourse in 2025 illuminates anxieties over eroding unipolarity more than systemic failure. No collapse necessitated reversal, evolution prompted adaptation. The U.S. sustains leverage through innovation, diplomacy, and market depth, while challengers advance incrementally. Sustainable order requires managing this transition constructively, enhancing transparency in settlements, coordinating on energy security, aligning with climate imperatives. As oil's role diminishes long-term, power will derive from technological leadership and institutional trust. The petrodollar story reminds us that economic arrangements endure through mutual benefit, not imposition. Navigating change collaboratively ensures stability in an era of shifting balances. In the expansive arena of international monetary relations, where the valuation of commodities like oil can profoundly affect the geopolitical leverage of nations, the petrodollar framework has represented a subtle yet powerful instrument of American influence for generations. This arrangement, characterized by the predominant use of United States dollars for pricing and settling global oil transactions, has sustained demand for the dollar, facilitated low-cost borrowing for the U.S. government, and reinforced the currency's central role in world finance. Narratives suggesting an imminent or ongoing collapse of this system have proliferated in recent years, often accompanied by claims of extraordinary American efforts to arrest such a decline and reassert control over energy markets. The assertion that the U.S. has resorted to unthinkable measures to reverse a petrodollar collapse captures the alarmist tone of much discussion. In practice, however, the system exhibits remarkable durability. Oil continues to be overwhelmingly priced in dollars on major exchanges, and no abrupt collapse has transpired. American policy has focused on pragmatic reinforcement, bolstering domestic production, calibrating sanctions, deepening alliances, and engaging diplomatically, rather than dramatic overhauls. As we extend our analysis, we consider the structural reasons for this endurance, the nature of emerging alternatives, the calibrated U.S. responses, and the evolving implications for global economic governance. The petrodollar's persistence is rooted in deeply entrenched institutional and practical advantages. Oil pricing in dollars is not merely convention but a function of market infrastructure. The world's principal benchmarks, Brent crude from the North Sea and West Texas Intermediate from the United States, are quoted and traded in dollars on platforms governed by established legal frameworks in London and New York. Contracts worldwide reference these benchmarks, creating a self-reinforcing cycle. Importers accumulate dollars to pay suppliers, while exporters receive dollars they often reinvest in dollar assets, including U.S. government securities. This recycling sustains liquidity in dollar markets, lowers volatility, and provides the United States with what economists term seigniorage, the profit from issuing the world's primary reserve currency. Challenges to this order have arisen gradually, shaped by broader geopolitical realignments. Russia's redirection of energy exports following 2022 sanctions involved settlements in rubles, yuan, or through barter-like arrangements with countries like India. These transactions, while reducing direct dollar usage in specific bilateral flows, remain marginal relative to global volumes and often involved conversion back to dollars for international purchases. China's efforts to internationalize the renminbi included pilot yuan-denominated oil contracts with producers such as Saudi Arabia and the United Arab Emirates. These initiatives demonstrated technical progress but accounted for only a modest share of China's vast imports by 2025. The expansion of BRICS and discussions on alternative payment mechanisms added to the narrative momentum. Proposals for local currency trade or digital platforms like mBridge illustrated possibilities for bypassing traditional dollar clearing networks. Yet practical constraints, differing inflation rates, capital control regimes, and limited convertibility slowed widespread adoption. The dollar retained its dominance in global trade invoicing and central bank reserves, with oil transactions reflecting this inertia. American approaches to preserving influence have emphasized continuity and adaptation over radical disruption. Domestic energy production, propelled by technological advances in hydraulic fracturing and horizontal drilling, positioned the United States as the world's leading oil and natural gas producer throughout the 2020s. Exports of liquefied natural gas to Europe and Asia pr. Audited alternatives to Russian supplies, strengthening alliances while generating dollar revenues. Diplomatic engagements sought to reassure traditional partners. Security commitments to Gulf states were reaffirmed through arms agreements and joint exercises, while new frameworks with India and Southeast Asian nations addressed energy security. Sanctions policy evolved with nuance. Enforcement targeted entities circumventing restrictions on Russian oil, disrupting shadow fleets and insurance networks without broadly alienating neutral parties. This maintained compliance with price cap mechanisms while avoiding escalation that could fracture coalitions. No overt military actions to seize or control supply routes materialized. Influence derived from market participation and regulatory authority rather than coercion. Under-examined elements clarify both resilience and speculation. The dollar's role extends beyond oil to broader trade. Commodities like metals and grains are also dollar-priced, creating compounding network effects. Legal predictability in US and UK jurisdictions attracts contract governance, while alternatives lack comparable depth. Speculative narratives often serve particular interests. Proponents of digital assets amplify de-dollarization claims to promote alternatives, while geopolitical commentators use them to highlight shifting power balances. Producers like Saudi Arabia pursue diversification prudently, exploring yuan sales and BRICS engagement, yet maintain dollar pegs and substantial treasury holdings, reflecting calculated hedging rather than rupture. China's yuan push advances steadily but confronts trust barriers stemming from capital controls and geopolitical frictions. The implications for global affairs are measured and ongoing. Incremental diversification enhances resilience for some actors against unilateral financial measures, fostering a more multipolar monetary landscape. Yet fragmentation risks higher transaction costs and reduced efficiency. Oil markets' dollar anchoring provides pricing stability but transmits U.S. monetary policy effects worldwide. Longer term, the transition toward renewables diminishes oil's centrality, potentially easing currency-related tensions while introducing new dependencies on critical minerals. American control manifests through competitive production and institutional depth, evolving with the energy landscape. In prolonged reflection, the petrodollar discussion in 2025 reveals more about perceptions of power transition than structural breakdown. No collapse demanded reversal, gradual shifts prompted calibrated reinforcement. The U.S. sustains primacy through adaptability, energy leadership, alliance management, market integration, while challengers expand options incrementally. The narrative of unthinkable actions underscores anxieties over change but overlooks enduring interdependencies. Sustainable governance requires navigating this evolution constructively, enhancing transparency, coordinating stability mechanisms, aligning with decarbonization imperatives. As energy systems transform, influence will derive from innovation and cooperation, ensuring monetary arrangements serve collective prosperity in a world where no single currency or commodity dictates terms indefinitely. In the complex and often opaque realm of international monetary policy, where the denomination of global commodity trade can confer lasting advantages on the issuing nation, the petrodollar arrangement has functioned as a quiet yet formidable pillar of United States economic preeminence. This framework, through which the vast majority of oil transactions worldwide are priced and settled in U.S. dollars, generates enduring demand for the currency, supports its reserve status, and enables the American government to sustain substantial fiscal deficits with relative ease. Discussions of a looming or actual collapse of the system have intensified in recent years, frequently accompanied by assertions of extraordinary American interventions to avert such an outcome and reestablish dominance over energy markets. The notion that the U.S. has pursued unthinkable steps to reverse a petrodollar collapse reflects the heightened rhetoric surrounding these developments. In actuality, the arrangement demonstrates considerable tenacity. Oil benchmarks remain firmly dollar-denominated and no precipitous breakdown has occurred. American policy has emphasized sustained engagement through energy production supremacy, targeted sanctions, diplomatic outreach, and institutional reinforcement, rather than abrupt or radical departures. As we further our examination, we explore the ingrained reasons for this durability, the character of incremental alternatives, the deliberate U.S. adjustments, and the unfolding consequences for the structure of global economic relations. The petrodollar's staying power arises from a combination of historical precedent, practical utility, and institutional inertia. Oil pricing in dollars is embedded in the operational fabric of energy markets. Major trading hubs, futures contracts, and physical delivery mechanisms all operate primarily in USD. This creates a virtuous circle for the dollar. Importers secure it for purchases, exporters receive it as payment, and both parties often hold or invest it in dollar assets, perpetuating liquidity and stability. The arrangement's informal origins in the 1970s allowed flexibility. It adapted to changing circumstances without requiring rigid enforcement. Over time, it became the default standard, reinforced by the depth of U.S. financial markets and the reliability of its legal system for dispute resolution. Emerging pressures on this dominance have manifested slowly and selectively. Russia's reconfiguration of energy trade following comprehensive Western sanctions in 2022 involved settlements in non-dollar currencies for a portion of its exports. Arrangements with India utilizing rupees and with China employing yuan or direct barter reduced dollar intermediation in those specific channels. However, these volumes represented a fraction of global trade, and downstream transactions frequently reverted to dollars for broader international use. China's promotion of yuan-denominated contracts gained symbolic milestones, initial sales from Saudi Arabia and other producers, but remained limited in scale, constrained by the yuan's partial convertibility and comparatively shallow offshore markets. Broader initiatives within expanded BRICS frameworks and technical experiments like cross-border digital currency bridges illustrated potential pathways for reduced dollar reliance. Discussions at annual summits explored enhanced local currency trade and alternative clearing systems. Practical rollout, however, encountered obstacles. Divergent monetary policies, varying inflation trajectories, and differing degrees of capital account openness hindered seamless integration. The dollar continued to account for the preponderance of global payments and reserves, with oil trade reflecting this entrenched position. U.S. efforts to preserve influence have centered on reinforcement of existing strengths rather than defensive overreach. Domestic hydrocarbon production, sustained at world-leading levels through technological and regulatory support, provided market leverage. Exports of crude oil and liquefied natural gas offered competitive alternatives, particularly to allies seeking diversification from traditional suppliers. Diplomatic initiatives sought to solidify partnerships, renewed commitments to Gulf security cooperation, expanded energy dialogues with Asian importers, and collaborative frameworks addressing supply chain resilience. Sanctions application demonstrated precision, focusing on entities facilitating circumvention while avoiding measures that could alienate key trading partners. This approach maintained adherence to agreed mechanisms like price caps on certain exports without provoking widespread backlash. Institutional advantages, deep capital markets, robust legal frameworks, and extensive clearing networks continued to attract participants, underscoring the dollar's practical superiority for large-scale transactions. Less apparent elements contribute to both continuity and heightened discourse. The dollar's role transcends oil, encompassing a wide array of commodities and services, amplifying network benefits. Transition costs for alternatives, revising contracts, building hedging instruments, training financial personnel deter rapid shifts. Speculative commentary often amplifies isolated developments for engagement, while vested interests in non-dollar assets promote narratives of imminent change. Major producers balance diversification with prudence. Currency pegs, reserve compositions, and investment portfolios reflect ongoing dollar alignment. China's steady progress toward yuan internationalization encounters inherent limitations tied to domestic financial controls and external perceptions of policy opacity. The broader ramifications unfold gradually across economic and strategic domains. Incremental diversification bolsters autonomy for certain actors, diminishing vulnerability to unilateral financial measures and fostering a more distributed monetary landscape. Yet it introduces frictions, reduced liquidity in alternative channels, heightened hedging expenses, potential for greater volatility in bilateral rates. Oil markets' persistent dollar orientation provides benchmark consistency, but transmits U.S. policy fluctuations internationally. Long-term energy transitions toward renewables and electrification may eventually diminish oil's monetary significance, redirecting influence toward new commodities and technologies. American sway evolves from singular dominance to sustained primacy, grounded in production capacity, alliance networks, and institutional depth. In sustained contemplation, the petrodollar conversation in 2025 M. Era's broader transitions in global affairs more than an acute crisis. No systemic collapse compelled drastic reversal, evolutionary pressures elicited measured adaptation. The United States retains substantial advantages through market participation and structural entrenchment, while emerging powers expand options cautiously. Claims of unthinkable interventions highlight transitional uncertainties but overlook underlying interdependencies. Constructive management of this shift, through enhanced payment transparency, coordinated reserve policies, alignment with sustainability goals, offers pathways to stability. As energy paradigms transform, influence will increasingly derive from collaborative innovation and resilient institutions, ensuring monetary systems facilitate shared advancement in a world of interconnected fortunes.